Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nuscale Power.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So,
Imagine holding the exact technology that the multi-trillion-dollar artificial intelligence industry is currently begging for. You hold the keys to the future.
right.
So why has your stock completely collapsed, losing like 3/4 of its value? Today, we are unpacking an almost dizzying financial paradox.
It really is.
We are looking at a company sitting squarely at the center of the AI energy boom, but the market just seems to be treating it like a failing enterprise.
Yeah, it's the absolute definition of a split-screen reality. On one side, you have retail investors just running for the exits, terrified by some truly apocalyptic headline numbers and, well, legal threats.
And on the other side,
On the other side, you have sophisticated institutional buyers quietly backing up the truck and accumulating shares. So the core thesis we really need to understand today is this massive mismatch in timelines. The retail panic is entirely backward-looking, reacting to past failures.
while the institutional buying is forward-looking.
Exactly. They're anticipating what comes next.
Right. So if you have been holding Nuscale Power since its highs of $57, looking at your brokerage account right now it's a physically painful experience.
Oh, absolutely brutal.
But before anyone hits the sell button in a total panic, we need to look past that deafening headline noise and understand what the billionaires are actually doing with this exact same stock.
Yeah.
But to do that fairly, we have to start with the elephant in the room. We need to dissect the brutal fundamental numbers that caused this severe drop in the first place.
It is a very understandable fear. To set the stage, the company is in what we call a pre-commercialization phase.
Meaning they aren't actually selling.
Right. They have the technology designed, but they are not yet mass producing and selling it.
Yeah.
Therefore, traditional metrics like revenue and earnings per share are obviously going to look deeply negative.
Sure.
However, their most recent earnings report, which came out on February 26th of 2026, was a shock to the system even by pre-revenue standards.
Yeah, let me read these figures because they are jarring. The market was expecting them to generate $8.76 million in revenue. They brought in just $1.81 million.
A huge miss.
And the earnings per share. The expectation was a loss of 10 cents per share. They reported a loss of 80 cents per share. But the metric that I simply cannot wrap my head around is the net margin.
Right.
It currently stands at a negative 1,130%. Mathematically, how does a company even achieve a margin that low?
Well, it happens when your revenue is negligible, just that $1.8 million we mentioned, and your expenses suddenly experience an astronomical spike. The primary culprit for this entire earnings miss was a 3,000% explosion in general and administrative expenses, or G&A.
3,000%.
Yeah, their G&A hit roughly $519 million for the quarter.
Wait, why in the world would administrative expenses jump to $500 million in a single quarter?
Almost all of that, specifically $495 million of it, was a direct payment related to the fallout from their dissolved partnership with Entrar One Energy.
Oh, wow.
When you partner with another entity on structural infrastructure projects, it isn't just a handshake. You dedicate engineering hours, you reserve manufacturing capacity, and you sign complex contracts. Unwinding that process involves severe contractual kill fees, penalties, and sunk costs.
So it basically functions as a devastating learning tax.
Exactly.
But this is where my skepticism kicks in. How does a company that barely brings in $2 million a quarter survive a $500 million mistake? That sounds like a fatal blow.
It definitely sounds like it. But while those numbers look apocalyptic on paper, they actually mask the underlying optionality of the business.
How so?
The revenue miss is entirely about timeline delays in deployment, not a structural lack of demand for their product. If we look at the long-term models, analysts are projecting a revenue growth rate of around 119%, with long-run net profit margins expanding to 11.25% once commercialization actually scales.
Okay, but projecting triple-digit growth for a company that just missed its revenue target by nearly 80% sounds a bit like, Wall Street fairy dust. What is the actual tangible path to hitting those numbers?
It all comes back to pipeline conversion and the insatiable need for baseload power from AI data centers. We need to understand the mechanics of why tech companies are suddenly so desperate for nuclear energy.
Right, because of the AI chips.
Exactly. Running advanced AI chips doesn't just draw a little bit of electricity. It requires a constant, relentless surge of power, 24 hours a day, 7 days a week.
And traditional renewable energy sources like wind and solar are intermittent.
Right. The wind stops blowing, the sun goes down. You cannot run a trillion-dollar AI infrastructure on a power grid that flickers. They need baseload power, energy that is always on. Small modular reactors are really the only zero-carbon solution capable of providing that uninterrupted feed.
So the transition phase is the crucible here. They need time for these tech giants to actually start buying and building these reactors.
Yes.
But time costs money. If they are burning through more than $200 million a year in free cash flow, how are they not bankrupt right now? Are they taking on toxic debt just to keep the lights on?
That is the existential question for any pre-revenue tech firm. And this is where their financial health presents a surprisingly resilient picture.
Really?
Yeah, despite the heavy cash burn, they have zero long-term debt. None.
Wow, zero.
They ended 2025 with approximately $1.3 billion in total liquidity, and they're holding roughly $836 million in pure cash. Plus, they established a $1 billion at-the-market, or ATM, equity program.
Okay. I hear the term at-the-market program thrown around constantly in the financial media. How does an ATM actually function mechanically compared to a traditional stock offering? Because retail investors seem to despise them.
Oh, they despise them for good reason. In a traditional offering, a company might sell a large block of shares all at once to an investment bank at a set price. An ATM program is completely different.
How so?
It allows the company to literally trickle newly printed shares into the daily trading volume at whatever the current market price happens to be.
Ah, okay.
So on a day when the stock starts to rally and retail investors are buying, the company's broker is quietly sitting there selling new shares into that demand. It acts as a constant invisible headwind that caps the stock's upside while slowly diluting the value of everyone else's shares.
It's like they are slowly dismantling the floorboards of their ship to use as firewood just to keep the engine running, hoping they reach the island of commercialization before the ship completely sinks.
That is an excellent way to visualize it. The dilution is a severe, ongoing risk. But the catch to your analogy is that they possess the only valid map to that island.
Right.
That map is their irreplaceable regulatory moat. They are currently the exclusive U.S. nuclear energy company with a small modular reactor design approved by the Nuclear Regulatory Commission, the NRC.
Let's explore the mechanics of that moat for a second. Why is NRC approval such an impenetrable barrier for competitors? I mean, why can't a well-funded startup just build a better reactor and leapfrog them?
Because navigating the Nuclear Regulatory Commission isn't just about filing paperwork. It requires years of exhaustive safety testing, seismic simulations, core degradation modeling, and emergency cooling protocols.
That sounds expensive.
It costs hundreds of millions of dollars just to get through the review process. Competitors in this space, such as Oklo or Nano Nuclear, are facing a grueling, multi-year regulatory maze just to get to the starting line where Nuscale is currently standing.
Right.
If you are a utility company or a tech titan trying to meet aggressive decarbonization goals, you simply do not have 5 years to wait for an unproven design to grind its way through Washington regulators. You must choose the proven, approved design.
Okay, so if their cash runway guarantees their survival for the next few years and they hold a monopoly on NRC approval, the fundamental math simply does not align with a 75% drop in share price. That tells me this sell-off is heavily psychological.
Exactly.
How is that fear actually manifesting in the daily price action on the charts?
Well, the price action has been exceptionally brutal. It moved from October 2025 highs of $57.42 all the way down to the $11 to $12 range.
Just a massive drop.
Yeah, however, the psychological and technical state of the chart right now is implying what traders call a capitulation bottom. We recently saw the shares bounce over 40% off a 52-week low of $8.85.
So what exactly does capitulation look like mechanically? Does it mean the sellers just gave up?
Capitulation is the moment of maximum psychological pain. It is the point where an investor who has held the stock all the way down from $57 finally throws in the towel at $9 because they cannot stomach the losses anymore.
And that causes a final washout.
Exactly. The sheer volume of those final panic sales washes out all the weak hands. We saw a 66% surge in trading volume on the latest down day, with 46.1 million shares changing hands in a single session. This stock is also highly volatile, carrying a beta of 2.27.
Meaning it moves more than twice as violently as the overall market. We've also observed this intraday pattern where the stock shows strength in the pre-market and then gets aggressively sold off as the day goes on. Are we watching a high-stakes tug of war between short sellers and retail traders, hoping for a quick lottery ticket, like a dead cat bounce?
Those pre-market fades are classic washout behavior, shaking the tree to see who falls out. But if you look at the moving averages, a compelling setup emerges.
Okay.
The 50-day moving average is currently sitting at $12.06. The 200-day moving average is way up at $20.50. Right now, the stock is testing that 50-day moving average from below.
Reclaiming and holding that $12 level could trigger a substantial short covering rally then.
Yes, potentially filling the empty gap all the way back toward the $20 mark. The fierce 40% bounce off the lows confirms that institutional accumulation is occurring underneath the daily noise.
This brings up a fascinating divergence. Who is actually buying and selling down here? Because if you scan the newsfeed, you encounter a towering wall of worry.
Oh, absolutely.
Citigroup recently issued a downgrade, lowering their price target from $11.50 down to $9. And then there is the barrage of class action lawsuits from firms like Faruqi and Berger Montague, just screaming fire in a crowded theater.
And you have to add insider selling to that list. Over the last 3 months, company insiders dumped approximately 27 million shares, including high-level executives like the chief operating officer, Carl Fisher.
Wow.
When retail investors see the COO selling, banks downgrading, and lawyers circling, panic is the natural response.
Why would the insiders sell if the underlying technology is genuinely revolutionary? That feels like a glaring red flag.
It certainly looks alarming on the surface, but comes back to that duration mismatch we discussed at the beginning. The insider selling and the class action lawsuits are entirely backward-looking. They appear deeply tied to the fallout from the Entry 1 failure and the realities of the ATM dilution program we explained earlier. They are not an indictment of the core nuclear technology. Furthermore, the deadline for lead plaintiffs in those class action lawsuits passed on April 20th, 2026.
Meaning the headline shock from legal threats is officially in the rearview mirror. It is already fully priced into that 75% drop.
Precisely. And while the retail crowd is reacting to those past events, the smart money is looking forward. Massive institutions are quietly sneaking in through the back door.
Give us some examples.
Well, UBS Asset Management boosted its position by an astonishing 1,220%, adding 1.7 million shares. And Royal Bank of Canada grew its position by 623%.
That's incredible. What specific operational signals are these massive funds seeing that the retail public is missing?
They see tangible progress toward commercialization. Management recently revealed that the company has signed 5 exploratory non-disclosure agreements, or NDAs, with Tier 1 hyperscalers.
For context, Tier 1 hyperscalers are the absolute titans of the technology world, the companies building the gargantuan AI data centers.
And those hyperscalers are realizing they cannot rely on the aging public power grid. They need dedicated, reliable, behind-the-meter power located directly on site.
Right.
Beyond the NDAs, the company is actively securing the physical supply chain to construct these reactors. They formed partnerships with Framatome for European fuel fabrication, and they partnered with Ibarra Elliott Energy for steam compressors targeted for 2027. This is not theoretical posturing. This is the unglamorous, necessary work of building a physical supply chain.
That explains why not all analysts are trapped in the bearish narrative. Northland upgraded the stock to an outperform rating with a $21 price target, and Cantor Fitzgerald is maintaining an overweight rating with a $20 target. So we have the smart money securely in position and the worst of the lawsuit noise fading. What are the specific events on the calendar that will force the broader market to shift its focus from cash burn back to the AI infrastructure revolution?
The immediate catalyst is the earnings report scheduled for May 7th, 2026. The financial world will be laser-focused on any updates management provides regarding the pipeline conversion and those 5 hyperscaler NDAs.
And after that?
Following that, on June 2nd, 2026, the company is presenting at the Royal Bank of Canada conference. That RBC conference is a premier venue for management to publicly reset the narrative, moving past the Entry 1 disaster and refocusing institutional investors on the macro tailwinds.
Speaking of macro tailwinds, the U.S. Department of Energy is actively pushing initiatives to support the domestic nuclear fuel supply chain. Having the government financially backing the very industry you operate in is a structural advantage.
Oh, it's huge.
But the ultimate speculative catalyst, the rumor that seems to be driving the UBS and RBC accumulation, is the potential conversion of those 5 exploratory NDAs into binding power purchase agreements, or PPAs. Why does signing a PPA change the fundamental mechanics of the entire company?
It completely flips their method of financing. Right now, they rely on equity dilution through that ATM program to survive, which punishes shareholders. However, infrastructure projects operate on different rules.
Right.
A major bank will not lend you billions of dollars to build a nuclear reactor on speculation. But if you walk into that bank with a binding 20-year power purchase agreement signed by a trillion-dollar tech giant, guaranteeing they will buy every single megawatt of electricity you produce at a set price, you suddenly become bankable.
You secure traditional project financing.
Yes. The need to dilute your shareholders plummets, and the narrative instantly shifts from survival to execution.
That is the inflection point. So, bringing this entire analysis together, based on the fundamentals, the regulatory environment, and the technical charts, the bullish score for this stock sits at a solid 7 out of 10.
I agree.
The time horizon here is a multi-year hold, roughly 3 to 5 years, to capture that arduous transition from pre-revenue all the way to commercial SMR deployment. If a listener is staring at a bleeding portfolio right now, summarize the core thesis for me. Why does this company deserve a spot despite the 75% drop and the severe cash burn?
The core elevator pitch relies on their irreplaceable regulatory moat. They are the only U.S. company holding an NRC-approved small modular reactor design, positioning them as the premier, first-mover solution for the looming AI data center energy crisis. The near-term bearish sentiment, the class action lawsuits, the analyst downgrades, all of that is backward-looking and heavily priced into the current valuation. Underneath that surface noise, institutional accumulation has established a floor. If they successfully convert just one of those 5 NDAs into a firm contract, the financing model transitions from painful equity dilution to traditional project financing, leaving immense upside on the table for those willing to endure the volatility.
It really forces you to zoom out from the daily ticker tape and look at the grander technological shift happening across the globe.
It really does.
I mean, if artificial intelligence truly demands an insatiable, entirely unprecedented amount of continuous baseload electricity to function, doesn't the very first government-approved small modular reactor design effectively become the most valuable piece of infrastructure of the 21st century?
That's the million-dollar question.
And if so, are today's massive cash burns and painful dilutions just the tiny necessary price of admission to own a piece of the future? Something to seriously mull over as you watch those moving averages. Thank you for tuning in, reminding you that this has been Smart Wealth with Joshua, and we encourage you to keep exploring the incredible intersection of energy and technology.